the price of gold will in some way mirror the decline in purchasing power of the US dollar. So a twofold or threefold or fourfold increase in the price of gold over 10 years is what I expect. If past is prologue, as more generalist investors come into the precious metal space, silver should outperform, at least on a nominal basis, gold. So I feel good about both assets going forward. I don't believe that the current momentum, or at least the momentum they enjoyed in the last part of 2024 and in all of 2025, could be repeated.
Veteran resource investor Rick Rule believes gold prices will increasingly reflect the long-term decline in U.S. dollar purchasing power. Over the next decade, he suggests a potential 2, 3, or even 4-fold rise in gold as currency debasement continues. While bullish on gold, Rule argues that silver could outperform on a nominal basis if broader generalist investors re-enter the precious metals market. However, he cautions that the powerful momentum seen in late 2024 and throughout 2025 is unlikely to be repeated. For long-term investors, disciplined exposure to gold and silver remains a strategic hedge against inflation and monetary instability. Now, we present the clips from Rick Rule's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think what we saw in 2025 was a reflection of the price that gold and silver were underpriced for 3 or 4 years. We compressed the market. The circumstance that was present in 2025 with regards to pressure on US dollar denominated instruments existed in 2020 and 2021 and 2022, but the markets didn't respond. So I think that the move that you saw in 2025 was the unleashing the latent energy in a coiled spring. And by the way, I don't think that we're going to see that kind of move again for a while. The spring only comes uncoiled once. I think that the circumstance in front of us means that it is much more likely than not that precious metals prices continue to advance for as much as a decade. But they won't advance, I don't think, at the same rate that they advanced in 2025. It's wrong to believe that you're going to get 100% compound gains from here. I have said in interviews with you, Vlad, and with many other people that I believe that the US dollar will lose purchasing power at the rate of 8% or more compounded, and that the US dollar will lose 75% of its absolute purchasing power over 10 years. If I'm correct in that assumption, I think that the price of gold will in some way mirror the decline in purchasing power of the US dollar. So a twofold or threefold or fourfold increase in the price of gold over 10 years is what I expect. If past is prologue, as more generalist investors come into the precious metals space, silver should outperform, at least on a nominal basis, gold. So I feel good about both assets going forward. I don't believe that the current momentum, or at least the momentum they enjoyed in the last part of 2024 and in all of 2025, could be repeated.
Veteran investor Rick Rule argues that the powerful gold and silver rally in 2025 was a delayed reaction to years of underpricing. According to Rule, pressure on US dollar denominated assets existed from 2020 through 2022, but markets failed to respond until the coiled spring finally released. While he expects precious metals to trend higher for up to a decade, he cautions investors not to expect repeated 100% gains. Rule forecasts the US dollar could lose 75% of purchasing power over 10 years, potentially driving gold 2 to 4 times higher, with silver likely outperforming. Let's get back to the interview.
The gold price has gone from $2,000 an ounce to $5,000 an ounce. And if you look further back, I began denominating my life in gold and saving gold in the year 2000. And if you look back to the year 2000, the gold price is up from $250 an ounce to $5,000 an ounce. The counterpoint to that is it's very difficult for me to understand how the US dollar doesn't continue to lose purchasing power. And if you look back at history over a millennium, gold does well when people are concerned about the maintenance of their purchasing power in fiat currency denominated instruments. I would also point the detractors to the fact that the opportunity for correction, positive correction in the United States, is much different now than it was in 2011, simply because the net present value of unfunded liabilities in the United States over that same period of time is up 200%. And the percentage of gross domestic product represented by on-balance sheet liabilities is more than double, which is to say our ability to correct the imbalances in our economy caused by excessive debt and deficits is much less than it was in 2011. One of the things that happened with gold in the period 2008 to 2011 is that people bought gold as a consequence of their concern that the entire economy and the equities market would collapse. When it became clear that there was sufficient liquidity in the economy and that against all odds, investors and taxpayers trusted the government. Many of the reasons for gold holders to continue to hold their gold went away. I did not sell my gold in 2010, 2011. I continued to acquire gold, and that was painful for me in the short term. 2012, 13, 14, 15. I experienced a substantial price depreciation in the value of my physical gold holdings. For me, gold was never about an investment. It was never about a speculation. For me, physical gold was insurance against the deterioration in the purchasing power of the U.S. dollar. And I need to say, Vlad, then and now, if the circumstances that propelled me to own gold corrected themselves and my gold went down, I would be happy, not sad. If you regard gold as I do, like insurance, think about the set of circumstances that causes you to get paid. Life insurance meant that somebody died. Auto insurance means that you got a wreck. Home insurance means that your home burned down. And gold is, if you will, economic and political catastrophe insurance. And I would prefer not to have to live through one of those catastrophes. But I feel more comfortable. I sleep nights and stay calm, having most of my savings denominated in gold. To be sure, I maintain liquidity in U.S. dollars, but I save in gold.
Investor Rick Rule highlights gold's historic surge from $250 in 2000 to $5,000 per ounce and from $2,000 to $5,000 in recent years as evidence of long-term U.S. dollar purchasing power erosion. He argues America's rising unfunded liabilities and debt to GDP levels limit economic correction compared to 2011. Reflecting on 2008-2011, Rule notes gold thrived on crisis fears, but corrected when confidence returned. Unlike traders, he views physical gold as financial insurance, not speculation, protecting savings from currency debasement. While maintaining dollar liquidity, Rule continues denominating long-term wealth in gold for stability and peace of mind. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.